file is now opened. As you can see, the topic is portfolio theory and diversification. Now this topic is going to be continued again next week. Hence the reason why in the title of this topic you can see I'm saying portfolio theory and diversification 1. And next week when you will meet me, it will be portfolio theory and diversification 2. So in the same area, we're kind of expanding between week 2 and week 3. Okay. Now, before starting this session, I just wanted to quickly check if I have any students or more than one student today here who can join the sessions online using Blackboard Collaborate, but for various reasons such as they are not in the United Kingdom now and therefore are unable to join my workshop sessions. Okay, so if you are one of those students who is not able to take the on-campus session, mainly because you are not available in the country or you may be isolating, can you please let me know? Is there anyone with that kind of situation? Okay, Anna? All right. So you're not in the country yet, correct? All right. So as a result, you're not able to take the workshop session. So this is what I wanted to find out. If there are other students as well. I arrive at okay, you'll be here on the 10th of October, but then you may need to, I don't know what is the rule, and the rules have been changing every now and then. So, and if you need to isolate for those 10 days, then you may again miss all right, that's good. So if you don't need to isolate, that's perfect. Okay, fantastic. But for all those students who are not able to join the workshop on campus, we will see how best we can help you. Okay, we may be able to organize online session for you, and this is something I wanted to find out first. How many students are there who are not able to make use of our on-campus session, those that we are delivering in our Bloomberg room? Okay, so if you are one of them and you are therefore not able to take those on-campus sessions, please email us, either myself or Sava. Okay, and you know my email address, and I guess you also know Sava's email address, so thank you very much. Okay, I'm still sharing the screen, and now you can see our learning objective for today. So it is mainly related to returns, and return is important. Okay, so we'll be learning about returns today, and we'll also appreciate different types of returns, why those returns are important. Okay, for example, today we'll be talking about return in value terms, such as return in dollars, return in percentage, holding period return, average geometric return, and also return from the shares and bonds. Okay, basically what we're trying to do here is we want to build that foundation which will help us understand models such as CAPM, capital assets pricing model. Now, you may have learned about these in the past, but the focus here in this module is applied. So you want to see and check for yourself that this makes sense when we make use of some real world data. Okay, and of course we always promote the skills that you need to compute them, to understand them and analyze them through making use of tools such as Microsoft Excel and Bloomberg. Okay, can I also quickly mention about the topics that we captured last week in our workshop session? In the workshop session, we didn't emphasize a lot on Bloomberg, but we made use of some web pages such as Financial Times. We also talked about Morningstar, and we were able to see how Morningstar screening tool can be applied to find out the type of equities that you want in your portfolio. So we talked about those types of resources, and I told you there are so many others that are available which can do somehow similar to Bloomberg, but Bloomberg is a tool that we have in our campus and it is much more advanced, and you'll also get the opportunity to mention in your CV later on that you've got the knowledge and skills related to Bloomberg commands, specifically those related to the investment portfolio. Okay, of course we also answered questions related to risk tolerance, and I requested you all please find out your risk tolerance by making use of at least 5 different web sources. Confirm your risk tolerance level and then match it with one of the slides in my previous lecture slides and find out your score in between 2 to 4. Okay, and they are going to be important because you may want to compute your utility score, or what should be the weight of your investment in risky assets. Again, the risk tolerance will be important there. Okay, so those were some of the important aspects we captured in our workshop last week. If you still have any confusions, please feel free to speak with either myself or Shaba in your respective workshop time. I've also requested you all that there is a drop-in session where Shaba will be available every Monday after 12, after midday. Okay, so feel free to go to the Bloomberg suite and find Shaba and sometimes myself to ask your questions. Okay, all right, so what we want to achieve today is something like this. What is it? I said to you that we have inside Blackboard site made available for your use some files such as these. So if you open these files, Morningstar 2018, then you see a diagram similar to what I have presented in my slide here. Okay, so you see that this is a chart. Okay, and the details about the chart and various numbers, figures are here. So I have simply taken, copied and pasted from here into my slide. Okay, so we want to achieve something similar to this today. So by the end of my session today itself, you should feel comfortable to make a chart like this yourself. Okay, so this is what we want to achieve. While achieving this, we will also become familiar with various tools that will help us find out mainly the returns and to some extent some risk. Okay, now we need to understand the returns thing and that's my slide next. But before jumping into further discussions, I want to quickly check if all my students are here, and if you all are listening me. Okay, so am I loud, clear? Everyone is happy with? Yeah, thank you very much, Bogdan. And because that you have confirmed this, I'm assuming that all students are able to listen to me, and at the same time they are also able to view the screen that I'm saying. And there's a question, I believe, asking, do you have, sorry, I need to read. Okay, do you have a link for other students who cannot join? Yeah, I think all students should be able to join using, if they are online, yes. Are you asking for later on once I finish? If it is for later on, as soon as I finish, this video recording will be available inside Blackboard. Okay, it may take some time to upload, but it will be available automatically. You can see each of my deliveries that will be uploaded. Is that all right? For a student studying this module who cannot access the module room live, yeah, I should be able to find a guest link. The guest link, okay. I know you want to help your friend, isn't it? So when I go to new session, the guest link should be shown. Get module room guest link, and new session. And in the new session, today is 5th, I should be able to find the link somewhere. Copy guest link, copy it, and this should be the one. Okay. All right, I found this. You're very kind, dear Galib. So maybe you want to forward this link. Okay, I hope it works. But thank you very much for your concern for your friend. I hope I answered your question. Thank you. All right. Okay, so where was I? Closing this student preview, start preview, and then I was here, but my slides should already be here. I was using the slide. So I hope I'm still sharing my screen, am I? Yeah, I'm still sharing my screen, and you all are able to hear me. So that's what we needed. So we're talking about returns, and you have been given £1 million that you can use, in fact, from this week, and I'm going to tell about it. Okay, so £1 million that you are given, and now let's say that after 3 months or after a year, for simplicity, it becomes 1.2 million. So what is the return in pound terms? It is 200,000. Simply the difference between 1.2 million and 1 million. So that difference is 200,000, and that is what we call the return in pound terms. So simple and easy, isn't it? Okay, so that's in terms of currency. But we're not interested in currency return. Of course, that's important for investors, but in this module, we'll be looking into, when we say return, we want to talk more in terms of that percentage return. Okay, we do not want absolute return. The return in terms of pound is the absolute return. 1.2 million from an investment of 1 million 1 year ago is giving you 200,000 absolute in Okay, but we are interested in relative return, and that for that we can find percentage return. Okay, now of course the slides is also talking to you about the cash and some other types of return. Okay, so that's not difficult because we know about dividends, and dividend can be paid by the company in the form of cash dividend, and the value of your asset may change, which then basically means there may be a price appreciation or price depreciation. So the share price, which was £100, may become 120 or may go down to £80. Okay, hence the reason why computing the return is important. That's what we are saying. So here we just quickly mentioned about dividend, and we also talked about capital gain or loss. Okay, now in the next 1, 2, 3, 4, 5, 6 slides, we're basically talking about holding period return. Okay, so in slides 6, 7, 8, 9, and 10, we're just talking about holding period return. So before moving on to a real world example, I just wanted to check if you already have this understanding related to holding period return. Do you know about it? Holding period return. Maybe you can think of what the name is suggesting. You buy and hold. You don't sell for a specific period in time. Yeah, and then you sell. So what is the return that you have received for, in a way, freezing that investment for that time period when you purchased and continue to hold that financial security? So that's basically holding period return. So this is just an example, and we can work out this example quickly, and maybe it's not a bad idea to go through share price. So here what I'm saying is you purchased stock of Apple, and then basically you want to find out how much dividend Apple paid, what is the share price of Apple now, because you can assume that you bought it 1 year ago. Okay, so by involving yourself into this exercise, you want to be more clear about what is capital yield, what is dividend yield, what is total return, what is income return, something that we also discussed in our first lecture, because we talked about 4 main objectives. They were capital preservation, appreciation, income, and total return. Yeah, somehow something similar is what we can do. So without wasting more time, what I will do next is I will find out, using Yahoo Finance, the share price of Apple stock. Okay, and then I have this, and when I see this, what I'm going to do is I'm going to this tab called historical data, and historical data shows me the share price. So by default it will be giving me 1 year, and if you can see the share prices, then you will see this, that they also report the dividends that were paid. Okay, so 0.22 in 6th of August, and if you scroll down further, again 0.22, so 2 times the dividends have already been paid in this 1 year period, and that's the third one. So 0.22 twice, and the third one is 0.205, which basically means on the second and the third cash dividends they paid slightly more, and then again same 0.205. Okay, so there were two dividends that were worth 0.22 and two other dividends worth 0.205. So we now know about the dividends. Of course, there are also other tools to see what you want to find, like dividends only. If you click, then apply, then you will get those details here just for the dividends. Okay, so dividends have been paid quarterly, and these are the total amounts of dividends that were paid. Okay, so that's very simple and clear, but we also want to see the share prices. So today, if you see from yesterday closing 139.14, and that's what I'm noting here, 139.14, and I'll go toward the bottom and I'll find out the last year same time the stock price, which is 116.50. So I've noted those two figures related to the share price. Okay, 139.14 and 116.50. Now I've got all the details that I needed, which then basically means now I can, in fact, open an Excel file and write down some details. What details am I writing here? I'm just writing the details that I needed in these fill in the blank space. Okay, so that's what I'm asking you. You sold the share exactly after 1 year when the share price was what? So the share price when you sold today were these. Okay, 139.14. Okay, Apple paid a dividend of how much? So we know 0.22 plus 0.22 plus 0.205 plus 0.205. These were the quarterly dividend that we were able to note. Okay, how many shares were bought? 1,000 is what it is saying. So therefore you find dividend income. So that's what we can do very quickly here, dividend income. So we'll go here and we'll say the dividends were 0.22, 0.22, 0.205 and 0.205. So in total, they are 0.85. So that's what you received as dividend. Okay, so you can say quarter one, quarter two, and quarter four. Okay, just to save the time, I'm not writing all those here. And then, therefore, you filled in this dividend income. If you say that the number of shares are 1,000, then it is therefore going to be 850 US dollars. So therefore, you can now mention 850 US dollars. Okay. Now this is the first computation with me, hence the reason why I'm taking this time to talk to you. Okay. Value of 1,000 shares. Okay. Value of 1,000 shares. What is it? So the share price time 0, share price time 1. So we can write here share price time 0 was 116.50. Share price now is 139.14. Again, you bought those many shares. This is what we are looking into. Hence the reason why when you bought those shares, you paid this much money, and today when you sold, you obtained this money. Okay, just to save time, I'm not filling all these details, but I'll just tell you very quickly what the answer would be. Okay, of course we really need to do a lot today, and I want to make sure that you are being engaged. Okay, so now in terms of return, if we think about dollar return, which is absolute value terms, then what we can say is the dollar return is basically this minus this. Okay, and then you also received this 850. So that's 23,490. That's your dollar or pound return. Dividend income plus capital gain or loss. Total return on your investment is therefore this money here. Okay, 23,490. Okay, so that's what you receive. Or if you wish, this would be easier for you, then first you can find this and then you can add these two together, whatever, but this is very simple. I'm just trying to match the format in the slide. Okay, so that's simple and easy, so we've already computed that. So now if we go down here, we now want to find dividend yield. So in terms of dividend yield, how much dividend did we receive in total for the whole year? And we know it's 850. So therefore, dividend yield is 850 US dollar divided by share price at time 0, and that's what we get. And this now is in percentage, which is 0.73%. Okay, that's good. We found this 0.73% as our answer. So we can say for per dollar we invested, we received 0.73 cent type of thing. Okay. Now here, in terms of capital gains or yield, what do we need to do? Price now minus price before divided by price before. That's what we need to do. So that's simply capital gain or loss. Again, I also need to mention loss because not all companies share price would always go up. So in terms of capital gain, we have here, we can simply use the share price at time t1 divided by share price at time t0. Okay, so that's what we can do, and take away 1, and that will give us the capital gain or loss figure. So new share price minus the old share price. So that's what we're doing here, capital gain or loss, and therefore we'll get it. Capital gains. Yeah. But remember, sorry, we also need to take away the share price at time t0. Okay, and do not forget to make use of the brackets appropriately, otherwise the answer will be different. So that's capital gain. Okay, now this, if you want to see in the form of a formula, you can say V1, value at time period now, V1 minus V0 divided by V0, or you can use this type of formula, price t plus 1 minus pt divided by pt. So you're getting 19.43% capital gain. How is that? You can talk about it. Now if you put it all together, then you'll be able to obtain your 1-year holding period return. So that basically means if you add capital gain plus your dividend yield, then you will get the return for the whole year, which is basically a holding period return. Now this can be broken into formulas such as this, which is equal your share price now, take away your share price in the past, plus the dividend that you received divided by your investment in the start. Okay, so therefore you will see that this figure and this figure matches exactly. Okay, now however, it is important to appreciate what constitute that dividend yield and what makes the capital yield. So if you just see a dividend t plus 1 divided by pt, that is giving you the dividend yield, and without this dividend factor here is giving you either capital gain or capital loss. So basically in this formula you've got both, which is capital gain as well as the dividend gain, and this basically is known as holding period return. I know I spent some time talking about this, but it's a very important concept, and this is something you need to provide in your assignment answer for your portfolio. Okay, so your assignment answer should consist of holding period return. And then you'll have the scope to talk about things such as capital gain loss, dividend yield, and so on. Okay. All right. So that was basically about holding period return, simple and easy. And I'm also assuming that it was a topic familiar to majority of you, but it's always important that we've seen it again just to refresh ourselves. At the same time, we also made use of a real world example using Apple. And you see, when you buy big stocks such as these, which are very innovative, there is some, if you see the data from the past, some kind of assured return, isn't it? Okay. I've got anything to ask on this so far? Any question? No? Fantastic. I hope you all found it really easy, and therefore now we can move on and we can see something more. So here we computed the holding period return for one stock, which is Apple. But in your portfolio, it is not going to be just one stock, because the portfolio basically means combination of more than one stocks, isn't it? So you will have more than one stock, and more the merrier if you think in terms of diversification. Okay, now we'll also be talking about how many shares are adequate for me to implement that diversification aspect, but that will be an agenda for our discussion later on. Here we're just talking, we computed the holding period return. That's fine, that's finished. What about return of the portfolio? How can we compute the return for a portfolio? Okay, and then it's again very simple. You just need the weight, because you would need to know how much you are going to invest in those financial securities from your limited available money. So weight of your investment is important. So you can say weight 1 times return coming from that first investment, plus weight 2 times return coming from that second, plus weight 3 times return coming from the third, and so on until your final stock weight n times return from that n. If you add them all together, and that gives you the return from the portfolio. Computing return is not difficult, whether for a single stock or for the portfolio. Computing risk becomes a little bit tricky. Okay, but this is something you learn in Banking Risk 1 with me starting from week 3 and also in this module. So please do not worry, we will provide you ample opportunities to look into the computation of risk side for a portfolio. Okay, now we've been talking about stocks all the time, but then you may be curious, what about the bonds? So when you need to compute the returns for the bond, these elements come into picture: accrued interest, clean price, dirty price, total return. How do we compute? What about change in accrued interest? What is price return and what is income return? Here in the example before, we have been computing the price return as well as income return. It was income return 0.73. It was price return 19.43. But what about bonds? Now, to answer the case of the bond, you need to understand that unlike with stocks, bond doesn't pay dividend, bond pays something else, and that's what we call coupon. Okay, sometimes also called interest. So that's important to understand. And remember again, the company has no contract with the shareholders to pay the dividend, but the bond issuers, they have a contract to pay the coupon to the bondholders. Issuer must pay the coupon to the bondholders. And that's one of the motivation why people buy bonds. And we talked about Manchester United Football Club issuing bonds, and they remain very successful in raising huge sum of money. We talked about it, didn't we? Now, just to understand all this, what I will do, I'll just show you one example here. Okay. Now, if you see this example, then you'll understand what is happening. On 1st January, Tesco issued 1,000 face value bond. Bond has a face value, which basically means this is the value the company would pay you upon maturity, also known as nominal value, also known as par value. Face value, nominal value, par value, they all mean the same thing, which is the value that is written in that bond instrument, which basically means I owe you. The company owes the bondholder that money. And it says semi-annual coupon of 4%. So 1,000 times 4%. £40 would be paid as coupon every year, but the coupon is paid semi-annual, which means £20, £20. Semi-annual totaling £40. Easy to understand, yeah? It was purchased at par by individual investor. So when you bought it from the market, you may need to pay more than 1,000. You may need to pay less than 1,000. Okay, but the question is saying to you was purchased at par, which basically means the bond holder has paid exactly £1,000. The first coupon will be paid on 1st of July. So exactly after 6 months time. The bond is quoted at clean price of 1,020. What is this clean price? The clean price is basically the price that doesn't include any accrued interest. It's just the price. Okay, so the bond is quoted at clean price 1,020 on 31st of January. So look into this question carefully. It is talking about January and it is finishing within January. So you therefore can see the question is asking, what is the rate of return on this Tesco bond for the month of January? It's not asking you to go beyond January. Okay, and then it is asking, what is the price return for January? What is the income return for January? Okay, so it's not difficult. Now, if you ask me, Binam, how important is it that I need to dwell and study in depth about the bonds? The answer, particularly for the assignment question, is do not worry, because the assignment only requires you to form a portfolio of stocks or equities. But for your knowledge, I do not want to compromise that my students do not understand bonds. I do not want to compromise that my students do not know how to compute return related to bonds and some other things such as yield and those treasury curves type of thing. Hence the reason why I have in the module included some topics here and there about the bonds as well. So now you need to basically compute the answers. So I'm just going to talk here, what is the rate of return on this Tesco bond for the month of January? So 4% is for the whole of the year. So 4% is for the whole of the year, isn't it? And that's 1,000. So 1,000 is face value, and the coupon interest rate is 4%. Therefore, coupon, I would say IR, interest rate, and therefore coupon is £40. That's how we computed it. And this coupon is paid semi-annually. That then basically means it is paid twice a year, so £20 each. Now, the question is asking just about January. So if for the whole of the year it's £40, just for the 1 month, it would be 3 point something, yeah, 3.33 coupon for each month. Okay, so that's what we can quickly mention from this. Now we need to find what is the rate of return on this Tesco bond for the month of January. So now what we need to do is similar to holding period return. We can now think of the clean price 31st January. Okay, so I'm going to write clean price end of the month is 1,020. Okay, So now we've got everything to help us compute the rate of return. So therefore the rate of return will be 1020 plus, this is what the bondholder will receive, minus the 1000. I can put them inside inverted parentheses. And what I need now is the dirty price at the start. Dirty price basically means one that includes accrued interest, but here at the start is 1000, so you can simply put 1000. Okay, so this is what you get, which is your total return. What is the rate of return on the Tesco bond? So rate of return. Okay, we found this. Next, the question: what is the price return for January? So price return is simply is very simple. Okay, so that's the clean price of the bond divided by the face value there, take away 1. So that's what you get as your price return, which is basically equal to capital gain or loss. Okay, so price return. And then what is the income return? So then the final thing is income return, and therefore for income return you've got 3.33 as income from your investment dirty price 1000. So you've got this. So if you add these two together, you'll get the same 2.33, which is not difficult. So that's what we obtained. Now this example I intentionally kept as a very simple one, but then if I were to say that someone was to buy the bond 31st January, then your dirty price would be 1003.33. Okay, that's what you need to remember. Yeah, dirty price includes accrued interest rate. Okay, now moving ahead, we also have topics related to inflation, fees, and taxes, because these are the factors that affect the return. And I'm going to give you some real world example in relation to inflation mainly. Okay, and by doing so, you will be able to make more meaningful analysis of a chart like this. Yeah. Okay, with that in mind, now what we need to do is move ahead. Okay, if you think I'm going fast, you can slow me down, and let me check if you all are listening me. If you all are there, are you all there? Good. Boring? Okay, just a quick question to everyone then. Okay, why is Ireland, anyone from Ireland? We always get so many students. Why is, tell me if you are someone from Ireland. You know, on St. Patrick's Day, there's a big crowd in Liverpool, relatively, maybe a bit small, but it's not bad in Newcastle as well. Why is Ireland a good investment? Okay, this is my question. What happened? Am I not able to post it in the chat? Something wrong with my... Oh, that's good answer. Okay. Why is Ireland a good investment? Do you think I would know about the income tax in Ireland? I mean, it's something good to know, but I really don't have much clue. You see, I just wanted your... Jasmine is giving a good answer. When I will give you the answer, you won't like me. Okay, I'm going to give you the answer. This was just to wake you up. Okay, sometimes, you know, I was a student myself, and when the tutor is talking a lot, it's easy to get lost. Although you think your eyes are looking into the screen, your ears are like sharp and listening, but your head can be somewhere else. Okay, this question was just to wake you up, so please don't feel bad about it. The answer is because you want to give the final word there? Say something. Okay. All right, that was just to wake you up. Okay. All right. So now we continue. But if you have any question, you need to ask me. Okay. But it was good to check that you all are listening and you all are now active. Oh, someone said something. Okay. All right. Okay. You're welcome, James and Bogdan and everyone. Okay. Now calculate the rate of return for a portfolio given when normal return and inflation rate were 10% and 5% respectively. Real rate of a portfolio. That's important, isn't it? Because all the time when we see the rates, they always talk the nominal rate. But how much are we gaining in terms of real rate? It can therefore be important. If you see the diagram that I said you will be able to make yourself, the bottom line here, which is green, is in fact the inflation line. Why is it important to talk about the real rate is because, can you see this orange line has merged with the green line this time in 1960s here, okay, or 1980s. You see now, given I'm getting old, I need thicker glasses, I guess. So that's I really can't read. God. 75 80s, okay. Oh, someone said that. What is the nominal return? Okay, nominal return is the rate prescribed by everyone. Okay, so if you go to a bank such as Barclays bank, mortgage or interest rates. So what is the interest rates? 1 year fixed rate, and all this. Everything that you see quoted, all these are nominal rate. Okay, so basically nominal rate is the rate that has not adjusted the inflation rate. Okay, so that's basically nominal, the rate that has not taken into consideration the inflation. That's nominal rate. But this is something you see everywhere. People, organizations, banks, even investment consultant, they do not talk about real rate. They will just be talking about nominal rate. Oh, Nathan, no, it's not bad. You need to ask questions. That's all fine. All right, that's good, Nathan. Thank you. And now, moving ahead, what we've got is that question, isn't it? That question here, calculate the real rate of a portfolio given when nominal rate and inflation rate were 10% and 5% respectively. So how do we compute? I think I'll write the answer here, okay? I hope you don't mind. I don't want to open Excel. I just wanted to change the color of my font. So 1 plus real rate equal plus nominal rate divided by 1 plus inflation rate. Okay, so if you do this, you will get the real rate. So to answer this question, 1 plus real rate is not known equal above 1 plus, you've got nominal rate 10%, so that becomes 1.10 divided by 1.05, and therefore your answer will be equal 1.10, 1.05. What is the answer? 1 and then somewhere around 5%. Yeah, should be the answer. But okay, I will do this. 1.10 divided by 1.05. 1.10, 1.10 and 1.05 equal this divided by this. I told it's somewhere around 5%, didn't I? So that's what you will get, 4.76%. Okay, so that's the answer here, 4.7676%. Now, this comes from economics, okay? And you can also relate it with Fisher's equation. But this is very simple. If you don't want to dig those details, just think. An example such as, I was earning £10,000 every year. Now, my boss came and said to me, I will increase your salary to £15,000 every year. So I was super happy about that. But what happened, unfortunately, everything that I used to buy, pay for my transport, they just increased. And now and we can also make assumption that everything that I was earning, that £10,000, I was spending all of them. Okay. So in the past, I had zero saving because all that I earned, I used to spend all of them. So 10,000 earning, 10,000 expenses. Now my boss has increased my salary, which then basically means I should be making 5,000 saving. But just now I came to realize that everything that I used to buy for £10,000 has gone up in terms of price. Okay, 50%. So I now need to pay 15,000. So what is my real saving? Nothing there. Yeah. So real rate is zero. And if you think that and apply it here, you'll get the exactly same thing. 1 plus that when it was 10,000 and when it became 15,000, it is because the expenses has also gone up to 15,000. The real rate of return is zero. There is no saving I'm making. So that kind of that kind of example should help you understand this equation, but do not worry too much. Okay. If you remember, 1 plus nominal rate divided 1 plus inflation rate gives you 1 plus RR, and that's fine. In some textbook, you may see RR equals this minus 1, but that's just taking what you got on the left-hand side to right-hand side. Okay. Now, other factors affecting return is like, return that has not taken into consideration the transaction cost. So for our assignment purpose, we've said to you that transaction cost can be kept as 1%. You can, and that's what you can do. So once you find your return, then you can just deduct that 1%, or you can apply it as and when you think is appropriate. But these are similar examples here. The gross rate of return is given, and annual fee is given as 1.5%. So what is the net rate of return? Now, in order to compute this, what you need to do is simply 1 plus 13 point, I think it's very simple and you understand this very well, divided by your cost, 1 plus annual fee, 1.5%, and then take away 1. Whatever answer you get is your return after the fees. Okay. Now in this case, it is giving you net and asking you to find the gross, but that's simple. Just use the same formula, and you'll be able to. That will give you gross net of fee return. So I've given you the formula here if you want to think in the form of a formula, but this is just common sense as well. I have a small typo here, sorry about that. This is not dollar, this is percentage. Okay, so we've gone through this as well, and this is just another example, something similar. So the more the example, the better it is for students' practice. But this is a lecture, and if you really struggle on this question, just let me know. But exactly same approach is what you would apply. I can in fact just tell you very quickly what you need to do here. 1 plus 2.41% will be divided by 1 plus 1 plus this is paid quarterly, yeah, here, which basically means this is annual rate, isn't it? So you just need to convert into quarterly. So okay, this means I have also answered this. Okay, nothing is left without answering. 4. Okay, whatever you receive, 4 3s are 12, 3%, isn't it? Or not 3%. So that's what whatever you received, you will use that in the denominator. Okay, so this goes on the numerator. Quarterly net of return can be computed simply by doing this. Okay, 1 plus 2.41% divided by 1 plus 1.2% paid quarterly. What will it be? Let me do the computation. 1.2% for, it will be 3, not 0.3%, isn't it? Yeah, not 0.3%. So not 0.3. Okay, so 1 plus 0.3%. Okay, take 1. That's your answer. So that's similar to what we've done before. Yeah, but here the question is asking you quarterly. Okay, so that's again not difficult. Another example related to taxes, you can look into it. Now we are into mechanics of multi-period returns. And here we've got things like compounding rates of return, linear and geometric return, chain linking return, effective annual rate. Okay. Now, I'm sure you have understanding related to this effective annual rate, because when I showed you what is there given by Barclays Bank, they are also making use of something similar. Yeah, AER. It's like effective annual rate. Okay. Now, we'll talk quickly about this, and then we will look into some real world type of example. Okay. I hope you all are still awake, and that if you need more jokes, you can tell me, but considering the time, I will now move on to this. Okay, I'm going to copy this, and then I'll paste here somewhere. Okay, I didn't paste it the way I wanted, so I'm going to make use of this. So now you've got that. So this is called effective annual rate. Hang on, what is in the formula? In the formula, I've got something called I, and I also got something called N. That's what I have actually. I don't have a great deal there. So then let me start with some percent, like let's say 12%. And this 12%, if paid monthly, you write 12. So that's number of payment frequency. And then if it is quarterly, you write 4, isn't it? And if it is half yearly, you write 2. If it is weekly, you write 52. If it is daily, you write 365, type of thing. So you understand this, yeah? Now I will say £100. It's not coming as pound here. Let me change. £100 is what you can write if you want to. 12% is what you can mention as well. Okay, so now I want to find out effective annual rate using that formula given there. So then basically what I need to do is 1 plus, then I need to say interest rate given divided by 12, because I said that's monthly, and that 12 needs to be repeated here, and that take away 1. Okay, so that's what we've got. Nothing more in that effective annual rate. So 12% paid monthly, what is the effective annual rate? Is it 12% or is it higher than 12%? That's my question. Do you want to say something? Where are you guys? Here. That's not difficult, is it? It's like something you learned in the past, but today is about return, so we can talk about it. Yeah, 12% per annum paid monthly. Is it going to be higher than 12%, the effective rate, or lower, or remains the same? Do you want to say something? Higher. All right. Okay, you don't need a question mark there, Bogdan. You're correct. Higher, and you know the answer. The answer is, because I remember for from teaching, 12.68. Yeah, 12.68%. So that's correct, isn't it? So now what I'm going to do is I'm going to type this 12% here, and then because that this formula is all there, so I don't even need this £100. Okay, so forget that. I'm going to put it here, and let's see what do I get when it is. Okay, let's do this. Okay, it's just one, and then it will be exactly 12%. Yeah, but I wrote 12, so I should not have written 12 there. I should have made use of the formula, isn't it? So please bear with me. It is F11 and then F11 again. So trust me, I haven't done any changes. It's just 12.68. Before I forgot to make use of the formulas. Now it's the same. Okay. So instead of 12, I put 1, then it's 12. It's like simple interest rate, isn't it? Now I go from 12 to semi-annual, then to quarterly, then to monthly, then to weekly, and then to daily. These are the frequencies that I can remember. Okay, and I'm going to copy it across, and you'll see they increase. Okay, but please do not expect them to increase forever, because if I put here, can you note what is the answer? 12.75. So if I increase here to something like 5,000 or 55,000, it doesn't mean that it will go beyond 12.75 or 12.76. It will still remain the same. And there's a mathematical logic behind it. See here, it doesn't change, did it? It changed from here to here, but it was before 365. It's not changing anymore, even if I say 10,000 or 100,000. Okay, maybe in decimal places you'll find some differences here, but not that big difference. Okay, so using the same logic, you know, there is this function that is applied in Excel, that is exp, isn't it? Equal exp thing. Okay, so that's something we exponential function, because it is just to say that there will be a limit. It cannot go beyond it. Okay, so I'll just keep it as simple as this for now. I'm just saying that in Excel you can use exponential function. That's it. Okay, so now I'll be making use of real world example to help you understand compounding. Linear and geometric return, I'll just tell you in terms of diagram, and maybe that makes it easy for you to understand. So linear, you know, like ordinary least square estimation approach. We've got the intercept thing, and we also got the slope, and so on. And these will be the agenda of our discussion in the days to come. So that's a linear relationship. Okay, so in terms of number, if you need example, 5, 10, 15, 20, 25, 30, 35, that's linear relationship. Okay, whereas if it is geometric, then it would be, again, I think you all know this, isn't it? Here, now I need this curve thing. I don't know. I don't think I'm good at doing it. Okay, something like this. Yeah. Stop. Okay. Sorry. Yeah, but it's not too bad. Okay, so slow growth and then increasing, something like 2, 4, 8, then 64, and then there is this type of growth, not linear. Okay, now when it is chain linking, it basically means how the value of the portfolio is growing. So if you think that you've got 12 different periods, such as 12 monthly periods, then you can have value at 12 um, and value at 11 month, value at 10 months, and so on until value at month 1. Okay, so on a chain linking return, what you can do, V1 to V2, what you received in second month, it can be divided by V1, and then times V3 can be divided by V2 times V4 divided by V3, and so on. Okay, so why am I talking all this? I'm talking about this because you need to understand geometric rate of return. Now, I can simply give you the formula the way they explain in the textbook, but the formula for geometric return, or you can also say before geometric return, continuous compounding, it comes from the concept of chain linking return. So basically here V2 and V2 cancels, V3 and V3 cancel, and so on. Okay, just think about it, do not worry too much. Question, just ask during workshop time. And this is very simple, arithmetic rate of return. And for geometric, I'm giving you this formula here, and I'm saying to you the foundation is chain linking return for geometric. And in some textbook, you may find something like this. I will be doing so many things related to that. Okay. And now, just to encourage discussion, I will ask you a question, and then we will move ahead with the real world example. So the question that I would like to float here is this, similar to the one in the slide. Okay, x1, x2, x3. So in year 20x1, 20x2, and 20x3. Okay, firstly, please, when it comes to rate of return, and when you are talking about portfolio return over a time period, it is always good in the investment scenario that you talk about geometric rate of return. Okay, now geometric rate of return is important, more important than arithmetic rate of return when it comes to a portfolio scenario where you have made investment for a longer time period. Okay, for a time period. So here in this example, I'm saying we invested £1,000. Was it 1,000 in this example? £100. Okay, £100. Unfortunately, the price of that stock went down, and in 20x to end of December, it is £50. Finally, there's a smile in your face in 20x3 December end, the value of the investment went back to £100. So the question is, what is the rate of return? Okay, so this is my question to all of you. Okay, so I want to see your answer there. What is the rate of return? This is my question. Yeah, you invested and the value was 100. Next year, how will you feel? Very sad. Okay, and then after that, maybe you'll be fine. Yeah. Some is saying 0. Okay. Anyone else? I just wanted to encourage discussion. 0. Anyone else? Just 2 more answers and that will do. £100, second year 50, third year 100. What is the rate of return? Okay. Okay. I've seen some giving some answers. How about other students? Do you want me to repeat the question? I will very quickly repeat. We made investment, year 0, you can say. The value of that investment is 100. After 12 months, the share price went down, halved in fact, so only 50. But on the third year end, it went back to its original, the price that was paid, 100 again. What is the rate of return? Jasmine, Sam, less than 0 because of inflation, Luke 0, Jacob 0. All right, very good. Now I've got so many answers. I'm really thankful to all of you who have contributed here. Thank you very much. And I know in the mind you've got your answer. So I'm just going to make use of the formula that I showed you here when I was talking about arithmetic mean. Okay, so I'm going to see this. Okay, so this is the formula that I'm going to make use of and then see what will be the answer. That's the formula. So if I apply this formula, then I need to find out the rate of return. So that's a new value, like V2 divided by V1, isn't it? Take V1. So that gives me 50% loss. Yeah, so that's fine. I found them. I found it. And here 50 become 100. So I find the answer. That's 100% jump. Now, if I follow this formula for arithmetic mean, then the answer that I will receive is simple. The answer is x1 plus x2 divided by 2, isn't it? That's the arithmetic mean. Summation means add them together. Divide by n is 2. So if I do that, then I get this, and then I need to divide it by that 2 number, and the answer is 25%. Rate of return according to geometric mean. No, sorry, arithmetic mean. Okay. But then you said 0%. So who is right? Am I right? 25% or you? Of course, I'm wrong here. You are right. Okay, 0 is right. Because if you just see here, it was 100 and my investment was 100, and you know, divide by 100 or whatever you do, you still get 0. So your brain worked quickly and you found the correct answer. So congratulations to all of you. But that then basically means if I were to compute arithmetic mean, I would get a wrong interpretation of the performance. That would be a mistake. Hence the reason why I need to be applying rate of return according to geometric mean. Okay, so for that, what I need to do is, if you want to find in terms of formula product 1 plus, okay, power 1 over n, which is 2, take away 1, and you get 0 as your answer. Okay, if you do it slowly, implementing the geometric mean formula that I have displayed here, then what you would do, you will find 1 plus r1. So here 1 plus r1. Here you'll find 1 plus r2. And then once you find 1 plus r1, 1 plus r2, then you'll multiply them. So 1 plus r1 multiplied 1 plus r2 here. Okay, so where should I write? I will be writing here 1 plus, or I can simply write here. Yeah, here. This is what is happening. Yeah, I've multiplied. Yeah, 1 plus r1 times 1 plus r2. Then 1 over n. So what do I need to do? The product is then 1 over 2. And then I've got minus 1, so I do minus 1 and I hit enter. I get 0%, but I did it rather quickly here because, you know, whatever I've shown you manually can be done using product function, which is basically makes job easy and quick. Okay, there's also a function called equal gm, which is geometric mean. In Excel you can apply that as well, but I just find it a lot more easier because maybe I'm more used to using product function. Okay, and I think it goes same with Saba as well. He will also be using the product function when he computes the geometric mean. So that was just an example and appreciation of the fact that geometric mean makes much more meaningful interpretation as compared to arithmetic mean, mainly in the context of portfolio returns. Okay, so that's what I wanted to say. Now, after this, we need to dwell a little bit on the log returns. Now, can I say to you all that this is something you may find a bit difficult to digest if you do not have, you know, those log related background. And to all those students, I would request, if that is the case, then please go through this document which we have made available here. So that's in the end here, logarithmic returns derivation. So what I have got here in the slide is explained in detail in this document. Okay, some time ago when I was using the slide to teach, students found it difficult to digest what exactly is going in the slide. So very kindly Sava took this effort to make this Word document. So kudos goes to him for what he has done, written here, but it's exactly what is there in the slide already. Okay, but it explains the properties of the log, the relationship between exp and log. I mean, if you just want to like understand that it is just the opposite, then you can just do something like this, log of this, okay, and you get 1, and then you go exp something, you get this 2.71, which is what we are saying here, 2.7182, and so on. Okay, but essentially this is just in a way taken from the slide itself, and formula is proven. Please take your time to look into it. Here I'm just going to quickly explain, which is, you're happy with this geometric mean formula. Now you put ln on both sides, you haven't done anything, this ln and this ln cancels, so this then basically means you are allowed to put this. And think about this property of natural logarithm, where is ln a to the power k can be written as k ln a. Now it is same as saying 2q equals 8, isn't it? It's same like saying 2q equals 8, so q is here to say ln 8. Okay, now here what we're doing is, this side remains the same. This, I'm not changing this, I'm keeping it same as before, but this side now I'm applying this rule. So this then basically means where I've got power n, this I can bring it down as 1 over n, and then KLN A rule is applied, therefore I get this. And again applying the rule between exp and ln, I can write this, and finally I will be able to get to this point here. But generally the practitioners, including in the JP Morgan, what they do when they need to find the return, they simply apply equal ln function. Okay, so previous day share price was 100, today's share price is 110, so they will simply do ln today's divided by yesterday's. Okay, so you get this, but you may think, oh, that should be 10% because this is what I get. So there will be a small difference. This is what to do. We must have explained here in the Word document somewhere. Okay, slightly underestimate the returns. Okay, but this is like the normal industry practice, so we also do the same. Okay, so that was about log return. Now, in a way, we finished the theoretical aspects of various types of return. Okay, now we want to move on to more practical aspect, and for that reason, I do not need to show you the slides, but I can go somewhere here and type in something. Can I tell you, some professors are really kind, okay? And one of those kind professor is known as the guru of value investing. He also has so much on the merger and acquisition related value formation. He is called Professor Damodaran, and I'm just going straight to his data sets. And he has been working for New York University for, I don't know, so many years. Okay, and then I'm going to find the investment returns data. Of course, you can also find similar data, and maybe for longer time periods if you play around using the the using Bloomberg. Okay, but here I said I wanted investment returns. Yeah, isn't it? So what is it? What am I getting here? So I'll just type in equal stocks. Yeah, this is what I wanted: historical returns and stocks, bonds, and bills. Very important for me to understand. If you all are here, I don't want to find myself in a situation that it's just me talking with myself. Do I? No. So for that reason, as soon as I finish copying and pasting this work here in this worksheet, pasted already, and what I would do is I'll just delete everything else here, okay, because I don't need all those details. Okay, so I've got this, and it starts from 1928, goes all the way to 2020. That's impressive. You see, it saved my time, didn't it? Because now I don't need to bother about finding Bloomberg and locating those data. It would have easily taken so much time. And you can see how time consuming it is when you need to find some data like inflation rate, US. Okay, if I type this, do I get US inflation somewhere? Current inflation, maybe this one. Okay, it says 2009, 2000 to 2021. I'm not interested just for that. Historical is what I'm interested. Oh God, I need to close this. Historical 1914. Yes, that's what I'm interested in. So I'm going to copy this as well. And then I go down here all the way down until 2020 only, not 2021, because 2021 is not finished yet. And I'm going to paste it in a separate worksheet. Now, as I said to you, I want to check if you all are here. Are you all listening me? You're connected with me, correct? Yep. Super. Thank you very much. I told you about the fact that once I was talking myself for 25 minutes, didn't I? That was such a bad experience. Okay. Thank you, William. Okay, so I have downloaded this data. What type of data have I downloaded? I've downloaded the real world data. If I were to invest in S&P 500 stocks, basically large cap stocks. I also have treasury bill. I also have bond, which is like 10-year, and corporate bond. I don't need corporate bond. Just save my time, okay? And then I want to find inflation here. And inflation I want from 1928. And in this worksheet, I have downloaded them, but it is from 1914. I don't need it from 1914 to 1927, so I'm just going to delete them. So it now starts from 1920. I don't need the monthly one. I just need the average, which can be a proxy for the annualized inflation rate. Okay, so I have got this. Oh God, what happened? See here, this is in decimal 1.7, but here the one I have is already in percentage. So I cannot straight away copy them. I need to convert them into percentage first. So I'm going to divide it by 100, and therefore I get this. And now I am going to copy and paste them all the way down, which is what I have just done, and now percentage as well. So I've now got everything the way I wanted, I pasted, and now I just want to confirm that I have it. Oh, when I pasted, I forgot to paste as values. So I'm going to paste as values here instead of the formula. So it is now pasted as values and exactly ending in 2020. So that's what I wanted. Okay. Now I want to ask you all some questions, which is firstly, I'll put this here. Okay. The question is, I just want to think of a scenario, okay, because I want to keep you guys engaged. Assume your grandparents were very kind, okay? So, long time ago, back in 1928, they separated some money for you, and it was, in fact, dollars. Okay, is that all right? Dollars. Okay. It was 100. Okay. At the end of 2020, you came to learn about this investment made in your name by your grannies, okay, grandparents. What do you think will be the amount as of in the 2020? Just guess some values. Okay, so this is my question. Yep, I hope I didn't take too long to type this. I just want you to give me some answer. Okay, starting with the fact that your grandparents were able to take high risk. Okay, risk tolerance was high. This means they invested in stocks. So if they were invested in stocks, what would be the amount now? That's my question. Going to give a guess? £100. I'm sure. Don't worry too much. Just give a guess. Okay, you won't be wrong. Just for computation purpose, nothing serious going on there. And the main idea is to learn, geometric mean, arithmetic mean, all those things, which is simple. Jacob, 119,000. Okay, more than, is that 100,000? Okay, Bogdan is also giving some guess there. Okay, one more. 300,000 Marcus, maybe one more, 80,000. So you're all talking about investment in stocks. 90,000. All right. Okay, I've got some answers there. Fantastic. Thank you very much. 1.5 million. Luke, bang on. I don't know the answer yet. Okay, so all right, super. Now I'm going to type something else, which is going to be, what if your grandparents were highly risk averse and therefore they were only willing to invest in treasury bills? What would be the money now? Tell me. Money now, what will it be? Treasury bills? You've already given an answer for stocks. That's fantastic. I really love the way you are engaged. Can you give some answer for treasury bills, please? More than 50,000, 10,000, Krishnan, Marcus, 100,000 in treasury bills. Okay, 5,000, Jacob. Okay, that's fantastic. I've received some. Okay, Luke, 100,000, and so on. Okay, so I can understand the linearity and assumption there by Luke, like 1.5 million for stocks, then 100,000 for, yeah, okay, superb. Finally, what about the bonds? 5,000 Jasmine. Okay, let's see who is more closer to realistic number, but I mean, it's just to encourage discussions. Okay, no one is wrong. Trust me. If I were asked this question, I would also give those numbers myself. So bonds is now 150,000. Okay, Marcus is giving 150,000. Anyone else, please? Ooh, that's 300,000. Double that of Marcus. Okay, 200,000. 10. Alexander, is that for bond itself? Oh, that's such an great recession. Okay. Okay, I mean, there is a lot of engagement going on, so thank you very much. Now I'm just going to derive that answer. Okay, now I'm not going to show you any formula. I don't want you to think of any formula. Just think this: if it was £100, then at this rate of return is 43.81. Certainly it is going to become 143.81 next year, isn't it? You all understand that? Yep. So I just want to find a way to compute to arrive 143.81. Oh, I remember Binam told us to do something like 1 plus R1. Will that give me 143.81? Fantastic, I've achieved it now. So similar. Okay, so I have obtained this. Now I'm just going to double click here and it will take me all the way to 2020 and I will be able to see what is the money worth today. Okay, So if your grandparents were kind enough to put some money for you back in 1927, and therefore in 1928 you would have received 43.81% return, giving you 143.81 and so on, then today you would be able to buy a luxury house in Newcastle, because the money today would be worth this much. You can't see it now, can you? But I can just enlarge it. 592,888. So I think maybe few of you were not far away from this figure. So kudos to those who were closer. Okay, I don't want to go back and see them because I just told you no one would be wrong. And but can you see, if you were to invest in treasury bills, the grandparents, then the earning is just 2,083. That's not good, is it? And if it is trade, if it is bond, it's not that much again, 8,917. Now, something that I spoke briefly, I would like to talk about it again, which is called equity curve. Okay, so let's see the curve here. Is it smooth, nice, upward rising? Yeah, but up until certain period, it's not. It's kind of flat, but it has accelerated a lot from that point here. Okay, so that's what I wanted to show you. But having presented you this computation, I am now keen to show you all this in the form of a diagram. Okay, so I'm copied them all, and you can see it in the diagram format. And you will say, oh, Binam, I don't like this diagram. And I agree with you, because this diagram doesn't look nice. And just a while ago, we talked about logarithm, natural logarithm. So logarithm basically doesn't affect the magnitude. The magnitude is still the same. Okay, so that then basically means we can be allowed to do that. So just find the logarithmic scale somewhere, which is this one, and now it's in that logarithmic scale. Let's make it a bit dramatic, something like this. And you can start from 10 if you want to avoid this gap. The last thing I would like to do is to put the years in my horizontal axis. So that's what I have here now. Okay. So as I said to you before, I want you to be able to make this chart yourself. And that's what I have just done now. And this is something similar to what you had seen in my slides when we started. This is it, isn't it? I mean, you can do the background work and so on. But can you see here what happened? You can just see what happened this time period. Maybe there was some oil crisis during the 1970s, and but then something has happened this point in time. You know, the stock market crash of 1987. That's a dip here in the share price line as well. Okay, these are a few things that you can take into consideration and your analysis. Okay. So that's the diagram, but in essence, what has happened is important. So to go into a little bit more detail, what would be nice is to look into some indicator like average, then geometric mean, then max, then mean. Okay, I'll just put these. Okay, so average is arithmetic mean, for which in Excel I just need to do this, and I get somewhere around 12%, I think. Okay, 11.64. And what about these? The last column being inflation. Yeah, you know that. Okay, so I have these things here, and now what it is telling you in terms of the returns. Of course, you know, something that we said at the start of last week, higher risk, higher return, and that's proven here. Okay, Now, sorry about that. Geometric mean equal product 1 plus all of these power how many years? 1 over count number of years. You can just take any. We're just counting the columns, isn't it? Close bracket power 1 over. Oh, we've already done that, haven't we? So close bracket, take away 1. Now, are we finding the geometric mean there? Okay, so can you tell me what will be the geometric mean? Will it be higher or lower than arithmetic mean? I've computed arithmetic mean, which is closer to 12%, 11.6 or something. Now I just need to hit enter and I'll get that geometric mean. I'm asking you this question. In your opinion, the geometric mean will be higher or lower than that arithmetic mean? Guess? Okay, first time you all are looking into it. Any other guess? This 50% chance of making your answer correct, because you need to say either higher or lower. Okay. Make some brave attempt. We only have 15 minutes left. Okay. Okay. Lower. Okay. Don't worry. Okay, but the correct answer is lower. Thank you very much, Jake, and really appreciate Bogdan and Erica that you contributed here. Always and always geometric mean would be lower than arithmetic mean. Think about the concept itself, the way formula is there, and if there are, you can say, if there is no volatility, then they can be equal. But realistically speaking, when you use the real world data, it is most likely 99% of the time geometric mean would be lower. So that's what we get, which is 9%. Okay, now I'm going to copy this and paste it along, and you found this. Okay, something that you will not find in textbooks, which is these returns also indicate risk. How? Risk. Okay, how? If you take the difference from arithmetic mean to geometric mean, for the instrument where the difference is higher, that is the riskiest one. Okay, so you see this is higher as compared to all others here. Okay, so this is one way of identifying risk in the absence of other tools such as standard deviation. So when I say standard deviation, why not compute it as well? Equal stdev.s, open bracket, way down, and I get the volatility. Of course, it is going to be higher for stocks and lower for the treasury bill. Okay, I'll convert it into percentage term. Okay, so we found this. Again, you can also find max, which is what was the highest return? Was it 43.81? No, maybe there was something like 50. Yeah, 52.56. What was it when it was the lowest, closer to Great Depression time? Yeah, 43.84%. Okay, final thing I would do is I'll just make a chart here, and I will use the column chart because this is something they do in textbooks. Okay, so that's what you will see in textbook. Basically, this is saying, can you see the share price investment in stocks gives you high positive return, but there can be a period of high negative return as well. What about treasury bills? History has proven that the government has never failed to pay the return that is expected by investors in the case of short-term securities such as treasury bills. Can you see there is no line underneath 0? So this is just indicating the same thing that we said again and again: high risk, high return. Okay, so with this, what we have done is we have done a number of things that is there in the slide, which is we talked about this. We made this diagram, and in fact my job was to copy this and paste it here just to tell you that on the diagram thing. And then we discussed about this. We talked about the returns. Okay, now something that you may want to learn is the multiple period holding period return. Okay, multiple holding period return, because before, when I presented you the example of Apple stocks, you remember here, this was a single period, single time period HPR, or holding period return, because we said we'll invest for 1 year. Okay, but you may be interested to invest for multiple period. In that case, you would find out holding period return for multiple years. Okay, and that's not difficult. You just need to do something like this. So if you go here, then if you want to find out for 3 multiple years, then you will just say equal. You've already done it here, haven't you? Equal 1 plus R1. I'm just repeating here again so that it's clear. 2, 2, 3. Okay, so that's what you have done, and then you will multiply them all. Okay, so it's this, this multiplies this, and again this multiplies this. Okay, so that's what you get, 98.747. This is what it is telling you here. Okay, and you just need to take away 1 to get the yield. So basically we call this, take away 1 gives you the yield, which is negative. Okay, so you can put the formula here. I don't know if I have written down the formula. The formula will be the same thing here, here, and then take away 1. Okay, that's it. Do not forget take away 1 for and you need to put it in percentage term. So here I need to say, how can I write here? Take away 1 on that formula. Okay, so that's done for multiple year HPR. We talked about this. We also looked into this. We found those variability in return. This is just to say to you, plot these graphs. Okay, so that's treasury bill related, hence the reason why you will put the treasury bill related graph here, and so on for the stocks. So you should be able to find the stocks related diagram somewhere, or I can quickly make one if you really want me to. Here it is. Okay, so found it. See, that's it. And you can do similar for bonds, and in case of bonds you will see some negative returns. Okay, so the purpose of this exercise was also to introduce you some key concepts such as risk-free rate and risk premium. All the time we tell students treasury bill is a very good proxy for risk-free rate. Okay, if you type in Google and go to Wikipedia or so, they may say to you that the yield given by 10-year government bond is a good proxy for for risk-free rate. Okay, but 3-month treasury bill is also a good proxy. Okay, so that's what I wanted to say, and you understand what is risk-free rate, because we show with the help of the diagram government never failed to pay what was promised, hence the reason why we can take it as a risk-free rate. Now, why would I invest in stocks when investing in treasury bill will 100% guarantee the return? The answer is you receive a premium. So what is the premium am I receiving here? So here in this case, the premium you are receiving is equal to this 8.28. So if someone says to you that invest in stocks, then you can say, oh, if I invest in treasury bill, I'm already getting 3.36. What will you give me? And that an asset manager would then need to compensate you with the premium, which should be 8.28%, that you get 11.64. So therefore this 8.28 is called your risk premium. Okay, now everything that we have done is not in terms of the real rate, they are all in terms of nominal rate. Okay, so basically if you needed to find out the real rate of return coming from stocks, then it will be 11.64 take away inflation 3.01, so 8.63 is S&P 500 given real rate of return. Okay, so you can see that the treasury bill given and inflation given is nearly close. There's only a difference of 0.26% point. So that's not a huge difference considering the time period of that investment. Okay, so in reality the treasury bill is only giving you 0.26% return in real rate. So that was something else that I wanted to say. So here basically the thing is we found this as well, didn't we? So these old slides are there for you to read. In fact, I've already gone through them. Now variance, all these you've done in the past, but I just wanted to keep them here so that they will be available for you as reference materials. But if you really struggle and if you think, oh, Benham, I still need help, then just give me a shout. But these are really not that difficult. Okay. Finally, there is this particular example related to S&P 500 index, and this will be something that I will be looking into. It doesn't take long, trust me. I will finish them all in 5 minutes or so, but I don't know why. I think it's best that we talk about it in the next session, which will be next week. Is that okay? Okay, Marcus, thank you very much. I mean, we did something very simple today, didn't we? But we need to appreciate the fact that although they are simple, they are meaningful. Now, can I quickly, you know, the reason why I wanted to stop there was also to show you something else, which is hopefully Saba is going to spend some time showing you this in the workshop session. But there are some places that you may want to see, and it talks about, you know, the rates of return every 10 years or so. That table should be somewhere, but all these documents are really good and important, and I would appreciate that you take out time to read them. Okay, so something that we did just now is also here. You can see them, and this is a very good analysis of different types of returns. That way you also understand the tools and so on. Okay, we're just trying to find one particular page, but this is such a big document, and I may not be able to find here the way I'm scrolling. It's also talking about, you know, the method that we just talked and used. Yeah. Okay, so can you see geometric and so on? Yeah, so you are doing something that Morningstar is doing. So I hope you enjoyed, and I hope happy learning. Okay, and please do not forget, it's not just this. The two articles here are really, really important and good, and just one table, if you see, you will understand how good these analyses are. Again, if you have the data, you can do these things yourself. See, something that I taught you is also here. I mean, the formula approach, but this is again another really good paper, hence the reason why we have kept here for your learning. Please make use of these documents, and this can be a great source for your discussion when you will be making those asset allocation decisions. Can you see here how interesting this is? Because this talks about equity, housing, you know, like bonds and equity type of thing. And you can see here that sometime it could be the case that compared to stocks, some other instruments are giving better return. Okay, so That's all from my side. And thank you very much for bearing with me. I know we didn't even take any break, but I hope you found it meaningful. So I call my day, and thank you very much. Okay, I'll see you soon. Bye bye.